Warren Buffett, one of the richest men on the planet, once publicly admitted that he pays a lower tax rate than his secretary, not because he's cheating, not because he's breaking any law, because he knows how to use a system that was quietly built to favor people who already have money. A ProPublica investigation using leaked IRS records revealed that the 25 richest Americans saw their collective net worth rise by $401 billion over 5 years and paid just $13.6 billion in federal income taxes. That's a true tax rate of only 3.4%. Meanwhile, the median American household paid around 14% in federal taxes. 3.4% versus 14%. Let that sink in. Today, I'm going to show you exactly how they do it. 7 completely legal strategies that the wealthy use to shrink their tax bills to almost nothing. And I'm going to tell you which ones you can actually use too, starting today. Before we get into the specific loopholes, you need to understand something fundamental, something that changes the way you see your paycheck forever. Our tax code effectively operates as 2 completely different systems. One for people who earn income through work, called earners, and one for people who acquire income through investments and inheritances, called wealth owners. Those who depend on salaries are subject to heavy taxes that are difficult to avoid. But those with enough wealth to live off investments can avoid taxes by simply avoiding taxable income entirely, while still supporting an incredibly lavish lifestyle. Think about what that means. When you get your paycheck, the government takes its cut before you even see the money. You have no choice. The taxes are already gone. But when a billionaire's stock portfolio grows by $10 million in a year, they pay 0 taxes on that until they decide to sell. And as you're about to see, the smartest ones are designed never to sell. Wealthy people organize their income in a completely different way. They make money from real estate, investments, and businesses they own, not from salaries. Understanding how these strategies work can help everyday Americans spot approaches that might fit their own financial situation. So let's go through the 7 biggest ones, starting with the strategy that lets billionaires live like kings without ever paying taxes. This is the single most powerful and infuriating tax strategy used by the ultra-wealthy. It has 3 steps: buy, borrow, die. Step 1, buy. A wealthy family buys stocks, bonds, real estate, art, or other high-value assets. They strategically hold on to these assets and allow them to grow in value. They won't owe income tax on the growth unless they sell. Step 2, borrow. The family borrows against the growing value of those assets and uses the cash to live off or to invest further. They do not owe taxes on asset-leveraged loans because the government doesn't tax borrowed money. Step 3, die. The wealthy family keeps the original appreciated assets until death, leaving them to an heir. Under current tax law, neither the original owner nor the heir has to pay taxes on the growth in value that occurred up to that point. Let's make this real with an example. Imagine you bought $10 million of Amazon stock 20 years ago. That stock is now worth $200 million. You haven't paid a single dollar in capital gains tax on that $190 million in growth because you never sold. Instead, you walk into JP Morgan Chase and borrow $20 million against your stock portfolio at a very low interest rate. You use that borrowed money to buy a mansion, fund your lifestyle, and invest in more assets. The interest you pay on the loan? Sometimes tax deductible. You live like one of the richest people in the country, and you have a tax bill of essentially 0. Then you pass the assets to your children. And under the step-up in basis rule, your heir's cost basis gets reset to the value at the time of your death. The entire $190 million in gains, completely wiped away from a tax perspective. Senator Markey introduced the Equal Tax Act this past March, specifically targeting this system. Teachers, nurses, and millions of working people keep our country running, but our tax code rewards wealth over work. The bill has not passed. The loophole is still very much open. This one has been in the headlines for years. Politicians on both sides keep promising to close it. It never closes. And the reason is that the people who benefit from it spend millions lobbying to keep it alive. If you're a hedge fund manager, venture capitalist, or partner in a private equity firm, the carried interest loophole allows your compensation to be taxed at a much lower rate than regular income tax. while someone just as wealthy in a different profession would have their income taxed at the highest marginal rate. A hedge fund manager's income is taxed at the long-term capital gains rate, which is significantly lower. Here's what that means in dollars. The top marginal income tax rate is 37%. The long-term capital gains rate for top earners is 20%. If a hedge fund manager earns $50 million in carried interest, they pay roughly $10 million in taxes instead of $18.5 million. That's an $8.5 million tax break just because of how their income is categorized. Regular Americans who make their money through a paycheck don't get this option. Your salary is taxed as ordinary income, period. No exceptions. The hedge fund manager next door, making 100 times your salary, pays a lower rate than you do. Two more powerful strategies, and the second one is one you might actually be able to use yourself. Loophole number 3, real estate depreciation. The IRS lets real estate investors deduct a portion of their property's value every year as depreciation, essentially telling the government that the building is wearing out. In reality, most real estate appreciates, but on paper, the investor is showing a loss, which offsets other income and reduces their tax bill. Wealthy real estate investors can own millions of dollars in appreciating properties, collect rent checks, and show a tax loss at the same time. It's completely legal and one of the primary reasons so many billionaires build their wealth through real estate. Loophole number 4, the Backdoor Roth IRA. This one is actually available to many working Americans, not just the super rich. Here's the setup. High-income earners are barred from contributing directly to a Roth IRA. For 2026, single filers earning over $168,000 and married couples earning over $252,000 cannot contribute directly. However, since 2010, high earners have been able to work around this limit by first contributing to a traditional IRA and then converting it to a Roth IRA. This strategy is called a backdoor Roth IRA. Once income taxes are paid on the initial contributions and gains, retirement savings can grow completely tax-free with no required minimum distributions. If you're in a higher income bracket and your financial advisor has never mentioned the backdoor Roth IRA, you need a new financial advisor. This strategy allows your money to compound for decades completely tax-free. It's one of the most underutilized legal tax moves available to upper middle-class Americans right now. Loophole number 5, Opportunity Zone Investments. Created by the 2017 Tax Cuts and Jobs Act, opportunity zones allow investors to defer and potentially eliminate capital gains taxes by investing in designated low-income communities. If you hold the investment for 10 or more years, you pay zero capital gains tax on any appreciation. The wealthy use this to park large capital gains from selling businesses, stocks, or real estate and turn a tax bill into a tax-free investment. Regular Americans rarely hear about this because you typically need $100,000 minimum to participate. Loophole number 6, the Augusta Rule. Here's one that small business owners can actually use. Named after the city of Augusta, Georgia, home of the Masters Golf Tournament, this IRS rule allows you to rent out your home for up to 14 days per year completely tax-free. The rental income does not have to be reported on your taxes. Wealthy business owners have turned this into a legitimate strategy by renting their personal home to their own company for board meetings, retreats, or corporate events, paying themselves tax-free rental income while the company deducts the expense. The legal limit is 14 days per year, but at rates of $1,000 to $5,000 per day for a nice property, that's $14,000 to $70,000 completely tax-free. Loophole number 7, state residency moves. Wealthy Americans often move to states with no income tax, like Florida and Texas. Some shift their domicile specifically to benefit from lower tax regimes. This sounds simple, but the numbers are staggering. If you earn $2 million per year in California, your state income tax is around $230,000. Move to Florida, which has zero state income tax, and you keep that entire $230,000 every year. That's why you've seen so many wealthy executives, athletes, and tech founders quietly relocate to Miami and Austin over the last 5 years. Let's be honest about which of these strategies are actually available to working Americans. The Backdoor Roth IRA, available to you if you're earning over $168,000. Start this year. The Augusta Rule 14-day home rental, available to any small business owner. Talk to a CPA. Opportunity zones, available if you have capital gains of $50,000 or more to invest. Real estate depreciation, available to any real estate investor, not just billionaires. State residency, available to anyone willing to actually move to a no income tax state. The top 1% of filers are estimated to contribute to a $160 billion per year tax gap, meaning the IRS is undercollecting $160 billion every year from the wealthiest Americans, in part because audit rates for large, complex partnerships fell from 3.8% in 2010 to just 0.1% by 2019. The system is not going to change overnight, but understanding it puts you in a better position to use what's available to you legally and to vote for people who want to fix what isn't fair. Here's the bottom line. The rich don't pay less in taxes because they cheat. They pay less because they understand a tax code that was written, in large part, by the people who benefit from it. Buy, borrow, die. Carried interest, backdoor Roth, real estate depreciation, the Augusta Rule, opportunity zones, state residency, 7 loopholes, 3 of which you can use right now. If this video opened your eyes, hit that like button and subscribe. We drop daily financial news that puts the power back in your hands. Drop a comment below. Which loophole shocked you the most? I read every one. See you tomorrow.